This is The Weekly on ClickOrlando.com with Justin Warmoth.
Good morning, I'm Justin Warmoth. Inflation is proving to be more stubborn than economists predicted. The latest report from the federal government revealed inflation actually went up 0.1% from July to August and 8.3% year over year. The news triggered a huge sell-off on Wall Street as investors prepare for the Federal Reserve to aggressively hike interest rates this week. This morning, the stock doctor Lee Siler is here to offer insight and advice for navigating this choppy market. All right, let's just get right to it and talk about your take on where the economy is currently. What is the state of the U.S. economy?
Well, I tend to think, and I'm in the camp that I believe we're already in a recession, and that was by the two negative quarters of GDP. Q1, Q2 were negative GDP, by surprise, by the way, and I certainly think that Q3 will be negative as well. Now, this is something that the Fed wants. This recession that we may or may not be in, I happen to think we are, but the decision on the recession will not be made until the NBER, an organization that decides whether we're in a recession, they'll make that decision 8 to 12 months from now. That, yeah, a year ago we were in a recession. So that's how it works. But my point is this is a Fed-induced recession or slowing of the economy because inflation has been so high.
All right, let's talk about yes, the rate hikes that we have been seeing, and really the meeting next week, we're going to see them go up again.
Another likely 75 basis points, which is 0.75%.
Right. And so let's talk about what the Fed is trying to do. You say slow the economy. Why is that so important for the Fed?
Well, you go to the grocery store, you use goods and services, prices are through the roof, and it's really hurting that lower tier of the demographic, the economic demographic. So the Fed, that's really the main problem we're having, and it's caused by a lot of different issues. You have the war in Ukraine, you have the supply chain situation, you had low interest rates for a long time and we were printing money for so long, stimulus checks, it goes on, the reasons why. And sure, those were unprecedented times with the pandemic. But now the Fed says, hey, the party is over and we have to start. Remember, we were at zero interest rates, Fed funds, 0 to 25 basis points. We're currently at 2 to 2.25. We will be 3 to 3.25 next week. Probably on our way to 4 and change by the end of the year.
All right, so you kind of touched on it, the factors that were at play here. So and I know it was unprecedented times, and we're dealing with a once-in-a-century pandemic, and places are closed, and the government had to step up and help people with stimulus checks and PPP loans and what have you. Is this something that when all that was happening, you expected in the future, ultimately, things are going to go up, prices are going to go up? Is that something that you expected?
I think they expected it, the government, but not to this degree.
Okay.
I mean, keep in mind, you had a year and a half where there was no spending. People held on to their stimulus checks, they work from home, so they save money. Working from home saves you money. Less gas, no dry cleaning, et cetera, don't eat out. So people weren't eating out, they weren't driving to work, they weren't spending, and all of a sudden the floodgates open. When the masks came off, and the economy went back to normal, the floodgates went open, demand went through the roof, supply couldn't keep up with it. You have shutdowns in China where we get our semiconductors. So it is just one big mess that we're trying to work through. And the only tool really the federal government has in its belt, or the Federal Reserve, is rising interest rates. They're gonna raise interest rates, and they need to. Their goal is to have 2% inflation. That is the Fed's target for inflation, which I think is gonna be almost impossible because shelter inflation is very sticky. The high rents, like we're seeing here in Orlando, you guys have done stories on it, that's over $2,000 a month to rent a place here in Orlando. That's gonna stick around for a little while because it takes time for those interest rates to cycle through that system. Right. So that's gonna be a problem. And you also have the wage inflation. That's not going away at all because everybody's going to $15 minimum wage. So that's here to stay. And I saw something, a McDonald's executive said that's brutal to their business model.
Folks are wondering and scrambling and really watching their bank accounts and saying, like, listen, I don't know what to do. What are the best tips you can give someone on that front? And then we'll get into the best tips on how to navigate this choppy market.
Well, I mean, I think that if you have cash, I think you need to have your 6 months to 9 months of emergency funds. I think that's most important because there is going to be job loss. I'm not saying this is what the Fed wants, but that's just what happens. When the economy recesses and rates are rising, we already saw Google's laying off employees. A lot of folks already have stopped hiring, and now the layoffs will come. So your job may be secure, but what if? And that's what you have to be prepared for.
All right, so this, as an investing, from an investing standpoint, obviously so many people have 401ks, and a lot of people are probably eyeing retirement, at least in the next few years. What's the best piece of advice there, and what do you expect with the market and how that's going to play out over the next year or so?
I think you need to take a look at your portfolio and ask yourself how much risk you're taking and how much risk should you be taking. And that usually you need a professional for that. But my point is, I see every day that a lot of folks, early 60s, looking to retire 3, 4, 5 years, and they're taking way too much risk in their 401k than they should be. So then when they see that their portfolio is down 25%, they're in shock. Well, you really shouldn't be, because your full bore stock market, and anybody at that 62, 65 years of age shouldn't be full bore stock market most of the time.
Right. So the flip side of that is someone who is on the younger scale. This is a great, would you say this is a great or an opportunity to buy and try to take advantage of the market where it is right now? What's your advice there?
I think your point really is important. The younger people that have time, if you have a 5-year time horizon, this could be a generational buying opportunity. It really can. You're buying, there's some great companies out there at deep discounts. I mean, there are companies out there still trading near pandemic lows. We're past that, but the stock and Wall Street is still punishing them. So there's great opportunity. And for those folks that are putting money in their 401ks, paycheck, or every 2 weeks, whenever it happens, that's great, because I call that invisible investing, and you're putting money in, your dollar cost averaging. So as the market is down 20%, 15% year to date, you're buying more shares than you would have a year ago or so.
What about is it better to just have an automatic buy, or is it's really hard to time the market out?
It's timing the
Let's
market.
talk about that.
It's not timing the market, it's time in the market.
Got it.
So you're a young guy, and you're going to be doing this job for quite a long time, and you're putting a percentage of your paycheck, you're getting matched. That's where people build wealth. I say this all the time. The wealth builders out there is that the 401ks, that you stick with the company for a long time, because pensions are a thing of the past. Not many companies offer that. Now what they do instead, they'll match your 401k, and that snowballs quite a bit.
Absolutely. I want to go back to inflation and the latest report that was not as good as expected.
Right.
Prices still up. What was your take on what was released?
I think a lot of it is noise, because there are things that, like I said, shelter is going to stick around for a while. Prices are going, we're seeing, as far as housing especially, if you take a look at Realtor.com or Zillow, if you have access to MLS, you'll see price reduction, price reduction, price reduction. Everything now, it seems now it's going to be more of a buyer's market than a seller's market.
Is that because of the rate hike?
Rate hike. I mean, you've just taken a pool of investors or a pool of buyers out of the market. Keep this in mind. December, if you were going to buy a $500,000 house, and at 3%, 3.25% rate, now at 6%, you can only afford a $380,000 house. So that is, you've lost a lot of buying power just by doubling the rates. And I saw a statistic yesterday, which is very interesting. For every percentage point, or 100 basis points, that the Fed raises rates, it costs the American people $230 billion in interest costs.
Wow.
That's because their credit cards just went up a point, their adjustable rate mortgages went up a point, buying a car is more expensive, everything is more expensive.
Coming up, the Stock Doctor will explain how this housing situation is different than the crash in 2008, plus his Wall Street forecast for 2023. Stay with us.
This is The Weekly on ClickOrlando.com with Justin Warmoth.
Welcome back. This week, the Federal Reserve is expected to once again hike interest rates as it works to slow down the economy and reduce inflation. That means higher costs for mortgages. With 30-year fixed-rate mortgages doubling in the last year, what should you do if you are looking to buy a home? The Stock Doctor, Lee Siler, is back now with that answer. Let's say someone is in the market and they're like, well, listen, rent, look at the price of rent. I don't want to pay more in rent than I would in a mortgage. I think that's probably not as much of the case as it was when interest rates were low.
No, I agree.
But still, what's your advice? And is it find a good opportunity, buy, and then maybe refinance later?
I think you have to be willing, most importantly, to hold it.
Yeah.
This is not an economy or a housing market you're going to be able to flip
time.
things, and it's not going to happen. So you need to find the house, the location you want, the house you want that suits your needs and your family's needs. If you want to buy now instead of throwing money away rent, I totally get it, but plan on staying in that house 5 to 7 years minimum. And then when rates go back down, which they will, We probably will never see 3% mortgages again, but you're going to see 4.5 at some point. Then you refi at that point.
Got it. On the inflation front, we had gas prices fall for 2 straight months, and I think that when you looked at it, I think economists just predicted that, with those dropping for 2 straight months, that this report would be better, but everything else is remaining up, right? I mean, that's really it. And you mentioned housing, and that's really a big driver for that inflation report. Looking ahead, what are you forecasting, and over the next year, what should folks expect? What should they be prepared for as we get into 2023?
That's a good question. We get asked about these forecasts all the time. I could just go based on history. I know that the month of September is usually really bad in the stock market. The market usually bottoms out September, October. Normally, meaning high percentage, 80, 90% of the time, November, December are great months. Here's what's most important, however. The third year of a presidential cycle, which we are going into next year, 100% of the time has been an up year in the stock market. 100%. Maybe it's due for a down year. I don't know.
Right.
But my thought is, that's because we know that, hey, we have midterm elections. We know this president has either got his policy in place or he's out. Whatever the case may be, the markets tend to like that. The markets like that kind of conflict anyway. They don't like to have one side of the aisle having all the control. They like conflict. So I think that next year we're probably going to be pretty good. And I believe that, yes, we're down this year to date, and the market's been down as low as 22% in the S&P 500. But I think we're going to end the year down overall, but maybe between 3 and 8%. We'll be down single digits. I think we can all survive that. And then next year we should be up, but modestly.
Right.
Because you're still going to be, interest rates are going to be high.
I think it's important too, and I'd like you to touch on this, that the differences, and really they're completely different if you look at it, the stock market and the economy. Yes, they have some correlation, but really you got to separate the two, right?
Yeah, you really do. And the stock market usually is a leading indicator of what's happening. So what we've seen this year in the market being down, that's telling us the economy is going to slow down next year. But remember, the Fed's raising rates at a historic rate. At some point, you've heard this term lately, pivot.
Right.
So at some point, they're going to say, you know what? Inflation's coming down. Now our rates are 4.5 Fed funds. Inflation's below 4. They want to kind of match those numbers up. So as inflation comes down, there's a happy medium somewhere. As inflation comes down, Fed's raising rates. At some point, there's going to be now higher rates than inflation. And then they're going to say, you know what? We're going to pause and see what happens and make sure, because these interest rates do take 12 months to get through the cycle.
Right.
And once the Fed says, we're going to pause and maybe the next move may be down, then the market's going to take a sigh of relief and probably have a historic rally.
Got it. Well, that's something to look forward to. I know the stock market likes optimism. It reacts to optimism. It reacts to pessimism as well.
Sure.
But I think when we have days like we saw last week with a 1,000-point drop on the Dow, I mean, that freaks people out.
It does.
Words of encouragement for the people. It's something I know that you want to look and you probably get that stuff sent to you. But it's easy to panic.
And my advice is, again, don't panic.
Yeah.
These things happen. This is history. It happens by the way, the market does better more than it does worse. I mean, we're up 4 years for every one down year. So look, this is our down year, and this will pass. It always does. This is not the financial crisis of 08, 09. People were worried about that.
People like to draw comparisons. And they also draw comparisons to the housing situation that we're currently facing. They're saying, hey, let's look at all these houses that have been on the market. You're seeing price reductions.
Sure.
It's going to fall off. It's going to fall off the cliff. Can we talk about the differences there and how you really can't say, based on, you can't compare the current market and how it is right now to 08? You
can't, because in 08, we had a ton of bankruptcies, foreclosures, and short sales. So the bankruptcies caused the foreclosures and short sales, and that was really when the banks were just unloading properties. That killed the housing market. We're not seeing that right now. We're basically a little bubbly, and yes, prices got ahead of themselves. I mean, I'm sure people look, and I know people have this hobby of looking at homes and, oh wow, I can't believe that house went for that. Everybody likes to compare, but things are going to back off a little bit now because that pool of buyers. And it's funny because the refi market is really important to the economy. And refis, you probably saw the data, has dropped 83%.
I imagine so.
From a year ago. And what's interesting is that, you can't even, most people, they've already refied many times. So now rates are 6%. You can't refi. In fact, there's only this is interesting, 452,000 people in this country would benefit from a refi today. 452,000 total borrowers. So and I like to break things down to the ridiculous. Let's say there's 50 states, of course states are larger. But that's 9,000 people, 9,000 borrowers per state that would benefit from a refi today.
Yeah.
Because rates are so high. Everybody took advantage of the 3 and 4% rates. So I think that when they start coming back down again, we'll see housing prices stabilize. Look, this is not going to go on for years.
No.
This is going to go on probably for another year or so.
All right, so quickly, do you feel like the lows are in for the markets?
The June 17th low, although we thought we were going to test it, I think those are in for the market.
Okay.
And we're going to have choppiness throughout the rest of the month, probably beginning of October. But I foresee November, December being pretty good because it usually, Wall Street seems optimistic year end. And I think that's what we're going to see.
I don't think our audience necessarily is in the investing group, but I'm sure they do have investments, but they're not trading or swing trading or whatever.
No, but you'd be surprised. Most people have 401ks and IRAs. And
absolutely.
And that's their investing, whether it be mutual funds or exchange traded funds. You don't have to be, and I'm not for heavy trading. I think that's a losing proposition most of the time, especially for an individual out there. Leave that to the professionals. Let's build wealth, and that's what we try to preach at our practice. Is we want to build wealth for our investors and our clients so that they can retire comfortably and don't have to worry about things like what we're seeing.
Let's just say that there is someone who is interested in trying to take advantage of the current market. Is there an area that you feel like has been hammered that maybe was hammered a little too much? Maybe it's a little oversold that you would like to hit?
Well, I think at some point, if you have that time frame, I think the semiconductor sector has been absolutely bludgeoned, and they are tremendously profitable companies. But when China opens back up and that flow comes back up, the president signed a bill that now they're going to have, they've given money to build facilities to produce semiconductors in this country, which should have been done years ago. But that's huge because we don't want to depend on China for supply flow of our semiconductors.
Right.
So I think that's a group that's going to do really well. And I think healthcare is basically recession proof. Those kind of sectors. And you can take advantage of that in your portfolio. You can have a little slither of a fund in technology or a little slither of healthcare along with the S&P 500 and some fixed income.
Some great advice there from the Stock Doctor. My thanks to Lee Siler for his time this week. For more information on the economy and the expected rate hike this week from the Fed, just head to clickorlando.com/weekly. I'm Justin Warmoth. Have a great Sunday.